investors and how investors are driving innovation, and particularly how investors are driving the innovation around blockchain. So I'm very proud to introduce someone who's also traveled from London, who's been described by a leading financial publication in Europe as arguably one of the most influential women in FinTech in Europe, and also the partner of the Cape Innovation and Technology Initiative for FinTech in Africa, CEO of FinTech Circle, Nicole Anderson.
Thank you. Super. So I can officially say good afternoon, Johannesburg. It's great to be here, and I'm sure many of you can already tell my accent is a bit of a giveaway. So lovely to escape the cold winter of London, and 17 years out of the country now, but very much feel right at home. So as Ian said, I have the joys of taking you on a little bit of a journey, which is going to be a departure, I think, from the real enthusiasts right in the technology to actually look at the professional investment landscape, both in Bitcoin and now emerging blockchain technologies. And this is really significant because there is a saying, I don't know who quoted it, but that if you want to follow the innovation trail, you follow the money. And having spent basically the last 5 years of my career dedicated to financial technology innovation, both disruptive and enabling, I've really seen that firsthand. And it really is death to the source of innovation if the money trail is not evident or easily accessible. And so I think this will ring true for most people in the audience. Really important consideration for any innovation ecosystem. So a little bit about FinTech Circle. We do 3 things. It's really simple. The first thing we do is we help early stage businesses with their funding rounds. So we have the largest independent high net worth individual network, which is an angel network, in Europe. And we fund businesses from all over the world using London as a gateway. So really, really core component of what we do. I personally, as a day job, run our corporate innovation practice, and the emphasis is on practice, so we get down and do things. We're not a talking shop. And one of the things we do is we source technologies for our clients, and we put them into incubation. We also do quite a lot of work for corporate venture outfits and entities, and we do that globally, and that's going to be a key relevant theme later on. And then the other thing we do is skills development. We launched a book, maybe some of you have seen it or bought it. It's on Amazon. It's not a little sales trip, but it's aptly called the FinTech book. And what was interesting about that was it was an experiment. We were incredibly frustrated having really mobilizing knowledge in a pretty nascent industry. If you look at FinTech as a core industry, it really is only about 4 to 5 years old. And so we were frustrated ourselves, grappling for really good content. So we actually went out and crowdsourced the best expertise and knowledge, and actually shaped up a book which you can now buy. And we've got another 3 in the series, including one on wealth management, one in insurance, and one on regulation and compliance. But out of that, we've actually developed an academy series, and I'm very, very, very proud to say that our first academy series outside of London will be launched here in Johannesburg at the end of April, and again with our partnerships with Citi, the Cape Innovation Technology Initiative. So don't miss it. It's going to be fantastic. Right. I'll move over this. All right, so I would like to abstract a little bit in terms of the blockchain topic, if you'd allow me to, and just look at the overall trends in financial technology, specifically the emphasis on FinTech over the last 6 years, because I think there's some very, very interesting patterns and also some really relevant lessons learned by the investment community when it comes to investing in disruptive technologies. For those of you who are keen research pundits, this is just out. This research is a product of both CB Insights, which is the largest, I guess, source of private investment data out there, very expensive if you're trying to subscribe, and KPMG. So they've joined forces to produce a quarterly publication called The Pulse of FinTech. So I know I appreciate it may be hard to read from where you're sitting, but I'll take you through the journey. So on your left-hand side is essentially the landscape of investment, overall investment over the last 6 years in this space. And it's a bit of a telling story. So undoubtedly, 2015 was the year of investment in FinTech, close to about $50 billion, right? I mean, it's just phenomenal. That number is really a consolidated number. So that is both venture, classic venture funding, but all kinds of financing, including even M&A. What happened in 2016 was a significant drop-off in that investment level, close to 46%. Huge. And what we actually saw is we saw only a slight marginal dip in the number, i.e. the deal count, the number of investments being made, which to the normal person on the street is actually a simple math sum of less money going into around about the same number of deals. And there's very good reason for this. All of us were expecting a massive consolidation, as markets go up and down. Much needed, I have to say, because for those of you who've been following the trail, 2015 was also the year of the unicorns, right? So billion-dollar companies, probably on average lifespan of 5 years. Insane. So there was a lot of capital finding a home, and this is the direct consequence of that. So we're all breathing a sigh of relief because the froth has come off the market, and it's a much more sensible market to operate in. What happened, though, however, is that actually there was a marginal tick-up in venture activity overall. So as you'd expect, essentially bleeding edge investors for tech are generally the VCs. But the life of a VC is becoming pretty tough. So overall in FinTech, a lot of headspace. Last time I checked, there was something like 1,200 corporate venture arms and VC arms focused on this space globally. So it's a very crowded space. And then what was really surprising for me was the rise of the corporates. So these are large enterprises, many of whom are represented possibly in this room, taking an active role in turning the eyes from adopting the technology to actually putting skin in the game. And this has been a dramatic shift. So this time last year, I was presenting to a CVC audience, and it was pretty impressive statistic of 1 in every 4 deals had a corporate VC partner investing. In FinTech now, it's actually 1 in every 2. They're not leading the rounds, they're co-investing, but significantly they're playing a very, very important role, and again, a very healthy sign for the way this industry moves. So if we look at blockchain, the picture is slightly different and actually counterintuitive, right? Well, for the enthusiasts in the room, you may disagree with me. But actually, the level of blockchain investment has increased, as you can see, between 2015 and 2016, and the deal count has dipped. So you've got this complete opposite scenario where there's actually more money going into fewer deals. And just by way of example, the average ticket price of a blockchain deal is around about $1 million, which is about 2.5 times the average generic fintech deal. But it's still very nascent. This figure is around about $550 million, represents 2% of the overall amount of money going into the broader financial fintech investment landscape. So unsurprisingly, and I think we're now into 1.5 days of what I think is a fantastic conference. There's the overriding themes of user adoption, baseline use cases that can be rolled out at scale are very, very hard to find yet. So the barriers to scale around adoption and the barriers to scale around where will this technology eventually settle in terms of regulation are really scaring most of the investment pundits away. But that's not a bad thing. So who are the major VC investors in blockchain and Bitcoin? Well, this is I think this is quite a nice rendition of the major players. Most of these players are Silicon Valley based, as you'd expect, bar the likes of Santander Innovate, which, as the name implies, is actually a corporate VC. I think, what you'll see here is an interesting pattern. There is a huge amount of crossover in the investment activity. So when you look at RRE Ventures based in New York, they've actually, cross-discipline. They've invested very successfully across multiple fund structures over many years. They're actually quite an unusual player. The likes of Blockchain Capital and Pantera Capital, I guess, are more attuned to deep competency, deep capability in their GP structures, people who really understand the technology, in fact, are technologists themselves or entrepreneurs in residence that are actually coming together and really going for it. So Blockchain Capital, I think, has just over 40 companies dedicated to the space in their portfolio. Pantera Capital, the largest institutional investor in Bitcoin. Anderson and Horowitz, well, 2.5 billion under management. I think they can play around. Mark Anderson, the guy who quoted "software is eating the world," is by far and away a huge empathetic social believer in Bitcoin, and specifically in the likes of financial inclusion. And it's his personal drive that's made them such a player. But I think the point to note is that there is a lot of crossover, there is a lot of co-investment, there is a lot of collaboration in this space because these investors who even they're the best of the best are learning from each other. But they're not the only guys in town, gals and girls in town. So I appreciate that this is even harder to see, but that's fine. My point is there are major big brand names who are putting skin in the game, and some surprising ones as well. The likes of Cisco, the likes of Verizon, the big tech companies. That shouldn't be a surprise, because when you look at the growth of the corporate VCs in broader FinTech, and you look at the giants of Google, Facebook, Amazon, and I think the term now is GAFA, which stands for essentially an acronym, terrible name, bringing all of these guys and girls together. These guys are actually the biggest threat to financial institutions in terms of their investment play and their commitment to financial technology innovation. And for those of you who don't know, there's a consortium now called Innovation Now, I believe. And it's a consortium of the big tech companies actually leveraging their power with the SEC in Washington to change US regulation when it comes to fintech technologies. So they are very, very powerful entities, and I think they will shape the broader big money in the market moving forward. So I know we've had a lot of, dare I say it, anti-bank sentiment, suspicion, frustration, but I think it's very easy to actually swing the pendulum from the black to the white. Having worked and currently working with many institutions, many of them financial institutions, it's not as black and white. There is a lot of new age talent going into these institutions, looking at the space, doing very, very good things. And they have very, very smart people. So I think we've got to pay attention to what the institutions are thinking about and doing for the short term. This diagram is actually the second edition of an extract out of a paper written by the World Economic Forum. It was titled The Future of Financial Services. It's 108 pages. For those of you who, I was going to say, need to nod off at night, good read. No, it is really a fantastic read. I would encourage you to read it. And the reason why it's so fantastic is it actually goes into the permutations of disruptive technology across the financial landscape. So each of those outer circles there represents a segment of financial services, insurance, capital raising, investment management, payments. And this depiction is the second chapter, and it was 100% dedicated to where blockchain is going to shape this industry. So whilst, as you can see at the, oh, no, it's on a different slide, whilst most of the use cases in financial services are the predictable use cases around payments, transmission, digital identity, etc. What you have here is a real depiction of how there are clusters of activity in almost every single segment of the industry. And I'm going to touch on the asset management space a little bit later. But the one thing they the one thing they all have in common is a number of value drivers. So operational simplification, regulatory efficiency, counterparty risk reduction, fraud minimization, liquidity and capital improvement, etc. So, this is the story of blockchain, and this is why these institutions are paying so much attention and spending so many, millions in this area. So this was a recent survey undertaken by, of all people, for some reason, Infosys, but it was actually really interesting. Was an under-hood discussion with people at C-suite level in these organizations, really trying to understand, how far adoption had gone within financial services. And unsurprisingly, half of the respondents said, look, they're going to be a wait and see. They're going to play on the periphery, but it's very much a wait and see. And the other 50% were actively doing things or engaging in some way, or, as I said earlier, actually putting their dollars into investing in solutions. Now, what's interesting, of course, is there's this huge dispute around when is what is the timeline in terms of adoption. And I think over half of the respondents believe, we're actually quite close, right? 4 years away, perhaps. I think the enthusiasts in the room would argue maybe even sooner. At least 70% of respondents were experimenting with permissioned blockchains, and the rest you are planning to use hybrid versions. And what I found very interesting is actually 30% have adopted for a consortium model, and I know, we heard from R3 yesterday. The consortium model, I guess, has been criticized. I think it's very hard, actually, at such a nascent stage, to discount the fact that you can learn a lot from these collaborative communities that have been formalized. But where the rubber hits the road, as I say, is actually engaging with the innovators that are changing the game. And at least 50% of the respondents in this particular study said they were going to be doing that. And what's interesting, and this is what I see all the time in my role, is actually innovation is such a misused word and such a misunderstood word that the people shaping large organizations' innovation strategies tend to come from all kinds of corners. And actually, when it comes to blockchain, the story is the same. So it's CIOs, CTOs, various lines of business, enthusiasts at the helm. It's a very, very mixed bag. So I thought what I'd do is just change tack very quickly. And I've talked about the professional investors looking at this space for return. But actually, blockchain, and I think this is much more in line with the theme of this conference, is fundamentally presenting the industry of investment management with, number one, huge challenge, i.e. as a contender, but also a huge opportunity. And having had the joy of working in the asset management industry myself and trying to move the dial in terms of getting them to innovate, that it's like the last bastion of innovation. For all the reasons you can imagine. Sticky value chains, nice fat cat earnings, although that's coming under pressure. Vastly complex industry. But it's becoming harder and harder and harder, whether you're an institutional asset manager, a wealth manager, even a private equity entity. The line of sight in terms of profitability is a very, very hard game. And that's, you know, post-crisis has just become more and more of a challenge. Really seeking and achieving alpha is becoming a fund manager's worst nightmare. So just to break even, the average asset manager has to have $150 million under management, which is actually not very much when you look at the larger players. And actually, the fees that they charge sit between 1.5 and 2%, and it's coming down. Most of those fees are taken up by essentially being compliant and keeping the lights on. Right? So this is a very tough squeeze on the average classic player in this industry. And what's really, really interesting, and I think we heard a little bit about that yesterday from Lou, he did mention it, probably just threw it out there, is that the move of you and I and the collapse of essentially these value chains as retail investors has meant that the whole passive investing market has grown rapidly. All right, so 72% of all investment activity from a wealth management perspective in 2016 was passive. All right. And when you combine that with 80% of fund managers underperforming, we have a problem, right? So the big question is, can the role of the portfolio managers and the classic asset management structures survive? And the question is, if they do not adopt and adapt to how they become way more efficient, way more transparent, and really serve clients, they will die. And this is where blockchain can save the game. So 3 weeks ago, I had the joy of being in Switzerland. February in Switzerland is a chilly, chilly, chilly experience. But for those of you who are cryptic enthusiasts, I encourage you to sometime put on your bucket list, your blockchain bucket list, a trip to Silicon Zug, which is an area just outside of Zurich, which has become now a cluster for activity in blockchain and crypto innovation. And I met this company called Melonport, female CEO, which is nice to see. And Melonport essentially have the first usable open architecture, Ethereum-inspired asset management platform, which they take into market. So they've developed their own token technology, and it really answers all the pain points of the industry in terms of, you know, transparency, reliability, lowering costs and time. And how it does that is it really is the most magnificent example of order taking, processing, asset allocation, all the things that could take weeks, they can do in minutes. So one to watch. So I'm coming to, gosh, I've spoken quickly. I'm making up time. I've come to the final considerations in terms of what keeps these investors up at night, right? So the thing with technology is that, and I won't get into an argument here about whether VCs are good, bad, or indifferent. But actually, when it comes to FinTech, one of the big challenges and one of the big questions being asked is, are the way in which technology, early stage or bleeding edge technology has been invested in, has been led by the venture community. The broader FinTech growth has really challenged the competency of many VCs, right? So, you know, when you look at the bias and the prevalence of VCs in Silicon Valley, and then you look at what FinTech is predominantly in that area, it's very B2C, right? So payments, lending, never mind, it'll come back to me. So it was mainly 3 segments in Silicon Valley. But when you start looking at the value chain and the complexities of B2B FinTech and enabling technology, it becomes a different game. And blockchain is now fundamentally challenging the competency of the traditional investors in broader technology. And the reason being is that most of these VCs are wired to a numbers game. right? Closed fund. It's under the hood, Pandora's box. They can do what they like. It's really, the volume of essentially the portfolio means ultimately at an 8-year return on investment, somehow there'll be 3 companies that actually make it all worthwhile. But the game is completely changed when it comes to investing in blockchain companies, because actually your consideration of the fundamentals and the moving parts are so different. So at the core of the investment criteria is looking at the deep, dark technology. And you have to really understand that. So the code base, the quality of the code base, the sustainability of the development requirements, and then the network effect of making Bitcoin, blockchain, crypto technology survive, such as your miners, your users, and your broader development community all have to be considered. So actually assessing the viability and the investability of companies is becoming really a different game. And so I still believe, and I think, we're on a journey. We're in a nascent industry. We're co-creating this. As I've shown with the example of the asset management industry, this technology is highly attractive to investors, but it's also shaping so many other industries. And this is, for some, a big no-no factor. All right, they just can't build the models to satisfy their own investment criteria. You essentially, as an investor, investing in the IP set first and the entrepreneur second, all right? And the commercialization or the addressable market is something way off. And these were the things that investors considered first. You're also investing on a standard, all right, or a set of standards, and those are macro issues that are way outside of an individual investor's control. And so my view is, if you're, and I didn't even ask if there were any investors in the room, and I'm glad I kind of didn't, but if your tolerance for return is less than 5 years, absolutely stay away from this space. This is a long-term play, and that's why I come back to the role of the big CVCs, because these corporates have better ammunition to ride the tide and sit tight. And so they make better investors overall. So, in conclusion, this is for the investors, this is only for the brave. But for those that are brave, this is basically an investment opportunity of a lifetime. Thank you very much.
Thanks very much, Nicole. Any questions? There you go.
Great presentation. You talked about melon pot, and
yes.
I'm interested in knowing, what do you think about blockchain-based crowdfunding models, and how do they fit into the future of investing in FinTech?
Oh, a great question. So again, I think, we're talking about this kind of technology convergence opportunity, and again, blockchain is finding its way into kind of the net new opportunities for investors as a whole. I think the question for me is not so much the blockchain component, because I have more confidence in that, in really gaining ground in terms of whether you're independent investors or institutional investors, giving you more transparency, speed, efficiency, taking out the layers that would actually add cost to how you invest. I think the question is more about the sustainability of crowdfunding as a mechanism for raising capital. And there it is the same old game, right? Crowdfunding relies on a two-sided marketplace. You have to have enough deal flow in order to satisfy your investors. And ultimately, those crowdfunding platforms that do succeed have reached a critical mass, either through the fuel of a shadow bank, pumping up their own ability to transact in liquidity, or they started very, very, very early on in the game and have managed to build a name. So, a great example of that is Funding Circle in not FinTech Circle, Funding Circle in the UK. But last year we saw the blow up of Lending Club, and that was because, fundamentally one of their biggest institutional investors pulled the plug. So I think crowdfunding is a topic that actually really needs scale to succeed, and then there's a saturation point. What's really fascinating, again, just from the UK perspective, is that the whole area of alternative financing has gone bonkers. The FCA, and we'll touch on the FCA later today, has done an amazing job overall in terms of being a driver for innovation as a regulator in the UK. But one of its tactics is to let the market run and issue licenses almost over and above what the actual market can absorb. And I remember last year doing a count, because all the licenses issued are in the public domain, and there were 2.5 licenses issued to alternative financing entities every month. I mean, there's only so many that can survive. So I think really look at the fundamental business model versus the underlying technology added value of blockchain as a requirement.
Thanks, right back, Manul. There we go, stick up your hand. That's great.
Thanks very much for the presentation. The last point that you made really struck me when you talked about the return outlook on these type of investments, and I'm just wondering what your experience has been like and what your opinion is of that relative to the traditional fund management industry, the pension fund industry. People are very benchmark cognizant, so they're not looking at such long-term investments. Well, often they're not. And just what your thoughts are on that, and what's the reaction been in some of those institutions when you talk to them about this technology and then come to the sticking point at the end of the return outlook? Well, the time horizon on the return outlook.
Yeah. Gosh, there's a lot in there. So let's start with the middle point, which is, what am I seeing in terms of penny dropping type discussions? I think the industry as a whole has plenty room. Even though they're in pain, they kind of don't know or don't want to know they're in pain. And because the pain is predominantly, there's only, I don't know if you've had the experience where you've injured your leg, right? But then because you've injured your leg, you trip over a wire and you break your elbow, right? Have you ever had that? No, I have. And you kind of go through this. So I was really painful in my leg, but now actually the elbow pain is taking over. And what I'm seeing is that it's kind of this relative pain threshold for what's my biggest pain. And the investment community, institutional investment community's biggest pain right now, and fundamentally has been since the crisis, is regulation. So unless you can talk the language of, all right, how this regulation transforms to fund performance, which is predominantly not a difficult conversation to have, the budgets, the attention, the people, the skills focused on how they can reinvent themselves around fundamental business models in investment are very few and far between. They've got teams of compliance officers, teams of risk, the story. So it's frustrating, but it's like, a frog in, sorry to use the phrase, but a frog in a microwave. They are boiling from the inside and they don't know it, right? So, that is a real issue. The ones who get it are actually decoupling, right? They're decoupling, and these are lessons learned again from kind of even retail banking, where some of the majors are looking at investing in, digital banks or building their own digital bank as a migration strategy in 5 years' time. And so the investment managers that are really serious about it are looking at how their fund structures perform through technology. They ring fencing activity. The other thing that I think is a real consideration is that the investment management community is only as good as its distribution. And when you look at how long the distribution chain is from an institutional asset manager to you and I in the street, the amount of stickiness and inefficiency is huge. So it's one thing innovating, and if they get that right, fantastic. But then how they take their product to market is another thing. And so I think one of the biggest issues of disruption is how you disrupt the value chain. And we're starting to see that. We're starting to see some huge growth of this kind of market provisioning area, a platform like Algomi, again, out of London, now headquartered in New York. They provide retail customers with fixed income, the experience is a fixed income investment platform, it's like institutional, with institutional rigor, but available to you and I. So this is just such a fascinating, it's just got so many ways in which this can play out, and I believe we will see an industry transform for at least 15 years, all right? The pension industry is another massive area. I'm personally involved in innovation in this particular area, and the pension crisis is driving, it's just phenomenal. It's a global issue, specifically for self-managed pensions. So it's very exciting to see, and I think the impacts for us, whilst we may not it's not that tangible to just average people, how this industry performs is highly relevant, because these are the power brokers that fund our infrastructure, that move, essentially fund economies, that power our economies. And it's key that they get this right.
Last short question. Thanks very much. Kat, over here. And we must wrap for lunch.
Hi, Tanya. Thank you so much. Great presentation. So one of the best use cases that we've actually seen for the Ethereum platform so far have been token launches. And you mentioned in this context the Melonport crowd sale, which recently had a kind of a pre-series or Series A token sale where they raised about $3 million in 2.5 minutes. That's after that the token sale was sold out. It's now worth about $5 million with the increase of Ether. So on Ethereum alone, there's been more than 100 million, I think, raised for startup applications. And that's very much a model that counters the traditional VC model. And I know for a fact that institutional money is very interested in actually entering this space. There's Fenbushi Capital, there's Union Square Ventures in New York. And return-wise, it's definitely in a bubble. But from a short-term perspective, these tokens have actually, in many cases, multiplied in value over very short time frames. So how do you feel institutional money is viewing these new developments where companies are building decentralized applications and raising directly money on the platform almost from their users and very efficiently doing so with a high amount of liquidity?
I would say they are paying very careful attention to the space. And again, there's so many lenses at which you could look at this phenomenon essentially at. I think the traditional fundraising ladder is changing completely. And again, thanks to, I think, the innovation we've seen in the last 5 years, the access, the collapsing of how you get access to an investment has changed. This is one technology that's enabling that. I think the thing to think about here is what's sustainable for an institutional investor. They need scale. Many of the aggressive ones are looking at social impact as an asset class and using that. So the rise of impact funds is, in the last year we've seen a multiplier effect, and this is one channel for that liquidity. So when it comes to technology investment, that's why I think it's so fascinating. The world of who gets a say and who's going to be investing at which stage, it's just a soup. It is an absolute soup. And I've been surprised time and time again about who's actually got their nose in. So when we help invest early stage companies raise money. Actually, when we look at who our angels are, there may be an individual, but behind them is a family office or a private equity company. They have links. So, I think it's definitely the VCs are being squeezed by syndication of independent investors fueled by their own power on the one side, and private equity and institutional investors coming in because they need to take a stake. So it's a tough game for the VCs.
Cool. Nicole Anderson, thank you very much. Thanks for coming back to South Africa.
Thank you.